analyzing potential Tesla, Uber, or Lyft acquisitions, and strategic corporate investment decisions.
Buy Uber or Lyft, right? So Tesla would not want that security or confidence. It better they let Uber and just drop, and then out of nowhere they just buy them, out of nowhere, boom. Same with Lyft, and that's the way these corporate executives have to think and have to operate. And those of you who don't know, like, I operate Elite Automation, which is our automation company, and we deal with corporate manufacturing people all the time, corporate engineers, directors, COOs, CEOs, that are involved in meetings with us because we are doing multi-million-dollar capital systems. And so these investments are pretty big investments for them. And we see like the way they navigate. We see the way that they spend their money and the way they put milestones in place and you know, they and like how like NDA protected certain things are. Like we have contracts with you know, some companies like Lucid that doesn't want, we can't hardly share anything. Like the max we can really share is that like we're a vendor of Lucid. Like nothing else we're allowed to say, or else like violates NDAs, and like, you know, technically they can't sue us necessarily, but they get to stop doing business with us. So my point being with all that is that the way that these CEOs have to operate, they have to operate in a completely different way. You can't have Elon saying that they might buy Tesla or Uber or Lyft, especially when they're at their most elevated heights, whenever they're hitting all new highs, right? That's not the time to be buying Uber or Lyft. That's not the time to talk about buying Uber or Lyft. The time to do that is whenever the stock has dropped, you know, 20%, 30%, 40%, 50% plus, you know. We need to see that major drop, and that's the time to buy. And also, I don't know if they can get past it without leaking it, due to they might need a shareholder vote to execute that acquisition. Now, if they can keep it under the rug and they don't have to have a shareholder vote to execute it, then maybe they don't have to present it to the public. But the point being is, you want to present it to the public at a locked-in price, because if you try to offer some locked-in price and the public knows about it before you can offer it, then the stock price is going to elevate to at least that price. It could actually go down too if it's already higher than that. I guess it could go down to that purchase price, because if you own that stock below that purchase price, then you will get that upside hedge, and vice versa. If you're buying at a cheaper rate, then that same thing will happen. It can drop it down because nobody wants to hold the stock at a higher price than what you're offering to buy it at. So that's just one of those things where it has to be delicate, and also like the SEC or whatever regulates things like this and makes sure that there's not stock price fluctuation due to it. Yeah.